Welcome back, everyone, to Mike on Money with our newest monthly feature, Monthly Market Mistakes. We're going to highlight areas of risk that we feel people are overlooking and need to better understand, and how these areas can affect their financial health. These are areas that we uncover during our normal due diligence process, looking at portfolios, markets, sectors, geographies, that we don't normally highlight in our regular updates because we're not really exposing clients to these things for reasons of risk. And it's worthwhile that you know about it for your own investment decisions. As always, I'm Michael LeBlanc, and this is Mike on Money. Today, we're going to be looking at Canadian private debt. They come in all shapes and sizes and have very inventive names. So when we talk about them, we're going to go into depth of what they are and take a look at your portfolio. And if you think you might have some and you're not sure, feel free to reach out. We're happy to answer any questions. We have talked about them before in older videos a couple of years ago, but since the failure rate of these are rising quite a bit, and we'll talk a little bit about that, it's really worth revisiting. If you pay attention to the investment landscape at all, you've most likely heard ads for these funds. They claim high yields, stable price, low correlation to equity markets, and more. And they may deliver all those things, maybe for a while, maybe for longer periods. But when things go wrong, they go horribly wrong. Most retail investors go into these funds looking for low risk, stable investment, and that yield. Especially Canadians. Canadians love yield, and as they should. It's a powerful investment strategy that can really pay off over time. But really understanding what you're actually getting might not be exactly what was promised. It might be something very completely different. Private debt has been around for decades, although for most of history, they were limited to accredited investors or institutional investors. That means the broad retail market uh, weren't able to invest in it. It wasn't built for the broad use in most people's portfolios. This was due to the type of risk we're going to be talking about, the long-term nature of these investments, and the complete or sometimes complete lack of liquidity associated with private debt investing. But what happened is back in January 2019, the regulators made some changes that allowed funds to offer non-accredited versions of these funds, and it's called liquid alts, or liquid alternatives. Liquid alts came, as I mentioned, in a lot of different sizes. It was primarily designed to bring private equity to retail investors, or people call them hedge funds a lot of times, which were also those accredited animals. But they made changes to be able to offer this to the broader investment community, which wasn't a bad thing. Um, but retail investors, I don't believe, have been completely informed as to what they're buying. In fact, retail investors were quickly attracted to this private debt area, or the private debt funds, because of that yield. As I mentioned, Canadians love it. Fund companies were coming out with 8, 10%. Some really interesting numbers, especially this. Remember, this was in early 2019, going into 2020, when the yield market was really low in the early 2020s, and more people flowed their money into these funds, and the companies were more than happy to accept it. Companies started launching new funds. Companies who did not have any debt funds in their repertoire started to make sure that they were getting a piece of that pie. Many of these companies were launching these funds really without any in-house skill sets or infrastructure around how to run them. So they were quickly going out and snatching up and hiring sub-advisors to manage all this inflow. And these sub-advisors, were companies that had experience in managing debt, but not all of them were the highest quality, or not all of them were staying as highest quality as perhaps the funds were touting out there. So there's this dark side of private debt that begins to flourish, right? Investors often fly blind into these debts, and the debt held in these portfolios are often in a black box. One of the key nature or features of private debt and liquid alts is that you don't necessarily know what's in there. You get very little detail as to where your funds or the funds flowing in are being deployed or how. What's the due diligence process on picking the loans, and they might have some general broad guides that say this is what we strive for, but it's really hard to tell what is actually being bought in those portfolios. Even as a professional, I've had fund companies come in and say, hey, you should buy this. I've asked for the due diligence process. They say, we're using a third party manager. I asked for theirs, and even the fund company doesn't have that. They don't know exactly what the third party managers are putting in there. So billions of dollars have flowed into these funds, and the companies are scrambling to get it invested. So you think about, there was this private debt market out there, and it had inflow from, as mentioned, those institutional and accredited investors, and all of a sudden, this new fire hose of cash is flowing in, and they're trying to deploy this cash into loans, and what ends up happening sometimes is you're not getting the full due diligence process on those loans, and fund companies start buying yield because they want that higher yield to offer you over quality, and that's degrading the overall portfolio quality as they continue to do that. And we've been at it now, as I mentioned, since 2019, so we've seen more and more of those things happen. And when things go bad, investors get trapped because the first thing a fund does is halt redemptions, meaning you can't get your money out. So when you buy these funds, they tend to have a little bit of limited redemption or liquidity anyway. Sometimes they're monthly, sometimes they're quarterly, sometimes they're daily, not too often. But that all gets turned off. You can't get out, you can't get your funds anymore for a period of time. You have no idea how long that period is going to be. You just know you can't get your principal out. And there aren't many safeguards to protect those that are caught in there, because the redemptions get closed, the fund companies now try to manage some sort of liquidity. I'm going to pause here to point out that I don't believe all debt funds do a poor job. Some are experts in the field and do try to manage the portfolios in the best interests of their investors, even though there are risks outside the manager's control, quite a few. Yields can change, right? Meaning if you expected an 8% return paid monthly, that could suddenly drop, maybe to only 6%. And this may not be adequate for your needs or many of the investors in the fund, which could lead to the largest risk of all, going back to that liquidity issue. Because investors start pulling out their funds quickly, the manager can be forced to halt redemptions, right? So regardless of them trying to do a good job, you can't just sell, or you can't get liquidity in loans that quickly. So they have to halt redemptions, meaning now you're stuck and you have no way of knowing for how long. And depending on the loans and the maturity, you can be at real risk of potential defaults, meaning if something goes wrong with some of those loans and there's no new inflows coming into the fund, or the manager has to sell part of their loan portfolio at a discount to create that liquidity, that can all result in losses to you, actual real losses. So that stability you bought these things for might not be there again, even if you have a quality one. Now, that is in the case of, as I mentioned, qualities, but let's look back at those funds we mentioned earlier, the ones that use sub-managers and are trying to place money quickly. Now you're twice removed from those loans, right? So you're not directly in contact or dealing with the manager, you're dealing with the sub-manager. You don't have direct access to what type of loans you have or the quality. Most think all these loans are secured by strong assets. You often hear real estate thrown around. Well, in many cases, that's not true. There are many small company loans, and inventory loans, supply chain loans, just to name a few, that can carry a much higher risk. But even if you do have real estate, that doesn't guarantee you anything. We've seen at least 7 funds halt redemptions that claimed real estate as their main loan book just in 2025, and there's been more than that since. In fact, if you think your private debt funds aren't at risk, please watch this quick video. So I've had many investors come to us after they were convinced to put a large portion of the portfolio in private debt with promises of stability and returns, and asking our help as their monthly distributions get turned off. They have no access to principal, right? They can't redeem, and in many cases, massive losses in the loan. So they've taken massive write-offs to the principal that they put into them. Um, and it's difficult because there's no visibility into how private debt funds are performing. The valuations are much less frequent than you normally see in an equity or an ETF, and they rarely alter that valuation until after a major problem has happened and the redemptions are turned off. So we've seen that in a couple of several examples where the redemptions get turned off, and then after it's turned off, they start writing off bad debt, and meaning your principal starts getting written off quickly, and those yields you're getting either get stopped completely or dialed back massively. And then now all of a sudden that stable, steady cash flow that you bought these for is completely gone. The whole point of being in private debt is to ride out the short-term volatility. But it's hard to know how borrowers we're faring, right? Like these loans out there, we have no idea what's going on because we don't even know which companies are borrowing the funds that you've deposited, because private debt managers limit the disclosure of those holdings for competitive reasons and also for their clients' confidentiality. Private debt managers have been scrutinized in Canada ever since back in 2021. Bridgin Financing, so this is a big Canadian or fund company, was put under the control of a court-approved receiver in 2021. The company managed 2.1 billion. They were mainly all retail money, and it collapsed so swiftly that people question whether other rivals could implode that quickly. And we have seen it happen since then. And a lot of these people will say, that was quite different. Bridgin, was fraud. The rival private debt companies will argue we're not like that. We're not fraud, and that could be very true. As I said, there can be quality managers out there. I'm not trying to say that they're all frauds like Bridgin, but they have to grapple with market forces like cost of inflation. It makes it harder for business to repay, higher interest rates, slowdown in the economy. All these things can affect the health of a loan book. And what used to be, that 8 to 10% annual yields you were getting can drop quite low, and even take some big negative impacts. And because these market dynamics are changing really quickly, especially in 2025, more investors have been asking for their money back. And when we see more and more funds see those redemptions, they have to halt them. Remember, they only have so much liquidity, and they have to turn it off. And as I mentioned, we saw in August 2025, I saw at least 6 funds turn off liquidity, and many of those around real estate. So again, there's no real area of protection. It can happen. It can happen anywhere. In other cases, there's trouble brewing below the surface where large borrowers have been sold off after defaulting on their debt. We saw a couple of those real estate companies or real estate loans that were in massive projects, and those massive projects go bankrupt, and the loan gets sold off. Now the timeline and the repayment terms are completely different, so that loan book changes really fastly if even one thing goes wrong, depending on the percentage of that portfolio is exposed to that one particular debt. And it's usually not just one particular debt, because when there's a problem in an area, it usually cascades to other ones. In all, private debt funds manage nearly 10 billion and have been really struggling with the elevated redemption requests and major defaults. And despite this pain, new private debts keep launching here in Canada, and the sector continues to explode around the world. It's over almost at $2 trillion globally. We see new companies jumping in on this area, promoting them. We've seen, as I mentioned, coming out with more and more inventive names. Historically, money invested in private debt usually came from those institutional investors who can commit their capital for a decade or more, but most retail investors can't, right? So as these problems happen, the real people that are going to be affected is the retail investors. So the question is whether this is a product suited for retail or properly serving them. Some buyers, and I'm including advisors in this, are not financially positioned to understand the ins and outs of private debt. A lot of them are just going after the yield. Clients get sucked in by that yield, often not really understanding those redemption halts and how quickly they can happen. And they might not have enough information to properly assess the risk that they're buying or what sectors that they're being exposed to. So what can you do? You're flying blind. There aren't many safeguards. Well, first of all, if you are, or if you do have private debt in your portfolio, make sure you understand what you're exposed to. As I mentioned, a lot of advisors might not even know what are in there. But reach out to us. I've got some pretty good contacts to at least better understand what might be in there. And be careful of your exposure. I've seen people have 100% of their portfolios in these funds. Maybe not all in one fund. I have seen that, but maybe not all in one fund, but across many funds. But again, these funds, a lot of them use sub managers, meaning you could have multiple funds all using the same fund managers or sub managers. And a lot of times, when we see big real estate or big loan projects of 300 million or more, they split that across different loans to different companies, meaning you could be exposed to the same loans through multiple different funds. You might not be as diversified as you think. So if you own these funds or you're considering them, contact us for a full review. Happy to go through your exposures and really maybe show you some alternatives that you might find a lot more attractive and take away a lot of these risks that are inherently built into private debt funds. So with that, thank you for listening. Stay safe and follow us for next week. We will tackle another monthly market mistake. Thank you and goodbye.